let's move on here. What exactly is the best way to use ETFs to stay invested? Let's get to our special guest. $3 billion in assets under management. His firm uses ETFs almost exclusively. Will McGough, CIO of Stadion Money Management, is here with us today. Will, your theme for investors is a home country bias. Why a home country bias?
Well, Bob, first of all, thanks for having me on. It's always great to be on set. We manage money for advisors through plan sponsors and participants for retirement. So having a long-term view is very important to us for a portion of our portfolios. And where we have equity, we prefer the U.S. because as bad as things are globally, the U.S. is still the place to be to invest your money. As you can see, with year-to-date numbers, jumping ahead of you.
Go ahead.
The S&P 500 is up 17% and change compared to EFA and emerging markets, in single digits. So it's a big move year-to-date, reflected by everything that all the folks on TV talk about as to why that's going on. Yeah,
so your tilt, U.S. 65%, international 35%. That's a big thing for you. Developing 80%. 20% emerging markets. That's a pretty heavy U.S. bias and a pretty heavy developed market bias overall. Developed meaning including Europe, essentially.
Yeah, that's correct, Bob. If you think about the MSCI and global market cap, it's roughly half U.S., half international. So we do have more chips in the U.S. bucket. And then we're pretty much benchmarked internationally. The MSCI is maybe 78-22 and we're 80-20. And international is so difficult because there's thousands of securities, and so owning the broad benchmarks.
Well, so far you've been right this year. I mean, the S&P 500 is up, 17%? If you look at the developed world, ex the U.S., that's a typical ETF that you get out there. You can do it several ways, but Europe, Africa, Far East, or SPDW, that's only up 7%. And emerging markets are up 4%. So far, the U.S. focus here, as you can see here, 2%, is definitely been a winning combination.
Right, and we're not looking at like year-over-year returns. Again, we're much preferred the long term. So the last bull market in 03 to 07, the opposite took place. But for this bull market, we definitely like the U.S. and large cap stocks to go with that.
And the weighting to large cap is pretty heavy again here. I mean, you seem to be an S&P 500 lover. So far, you've been right this year.
Why would you bet against the largest U.S. companies against the rest of the world? Right now, even with the volatility and the macro backdrop, they're holding up well.
And is it because we're dealing, Andrew, with the best house on the block, as everybody likes to say, and that's the whole story here, and there's no reason to change that. Even if we're somewhat, I don't know if overbought's the right word compared to the rest of the world, maybe that's not the way to characterize it, but clearly there's been an outperformance.
Well, look at what the big cap stocks are doing with their money. They're buying back their own stock, right? There's other things they can invest in and different M&A and things like that. The buyback numbers are record numbers for these large cap companies. They continue. I think they believe in that as well. And why not follow the CEO of a company that you may want to invest in? Many of these will.
So what could go wrong with this scenario? I mean, you're still in the fully invested. That was your point earlier.
Right.
Is there anything wrong with what he's saying? He's been right so far. U.S.-centric, big cap-centric over small cap.
No, I think when you to your point, when you had stated before how much of a percentage you're looking at in the S&P in different sectors, perception's reality. So everyone gets driven into the same large cap names, and we've all done those segments on the only 6 stocks that matter. And if you believe in that, then you've got to buy the Qs and you've got to buy the spiders. Yeah. That's what's dictating direction in the overall marketplace.
I got to ask you about bonds at this point. The investors must. Yes, I know you deal with the RIAs and people like that who invest for people, but they're asking about bonds. Is there any value at this point?
We firmly believe in the bond aggregate. It's got a longer duration at 6.5, but if you think about the world, there was a stat out today by, I think, Morgan Stanley, that the average yield on ex-U.S. sovereign is a negative 3 basis points for the first time ever. 2% for a 30-year looks attractive.
Yeah, but now you're buying on price, not on yield, for sure.
Rates are going lower, so why would you fade a 30-year bond bear market trend? You want to be long bonds until they're like super tankers. They're tough to turn. So once it does turn, it'll be pretty obvious.
I just want to point out, SPAB, is that a lower price version of AGG? AGG is
correct,
the general bond aggregate
that's
used.
Bloomberg Barclays Bond Aggregate Index.
Have you seen any ramifications within the marketplace? Because so many people own stocks now through pension funds, mutual funds. Have you seen the aggregate investment analysis filter through to the overall market where these dips are being bought quicker than ever? It's almost like a fast forward cycle that we're seeing in the investment community. Does that have anything to do?
You could say, the internet has sped things up, Twitter has sped things up. So on aggregate, we're seeing moves happen quicker and quicker, and the whole world's run, or the whole market world is run by algos at this point.
Yeah.
And look, human has to program them. So if you can kind of think like a programmer, you should be able to judge the movements pretty well.
You're in charge of retirement for Stadion, which means that you know a lot about the state of retirement. I look at the Vanguard and the Fidelity 401k programs, both of them two biggest in the United States. I'm a little concerned about the numbers there. I know that more people are saving, the numbers are up, and yet if you look at the amount of money that's in a 65 plus account, it's rather small. For Vanguard, I think the median for a 65 plus account was 55,000. A 401k I'm talking about for people 65 and older. That's very worrisome. That is not a lot of money. Is there anything we can do here as a government can do or individuals to sort of speed this up? Because the retirement industry needs to get out there and get the message out. The baby boomers aren't saving enough.
Our number one message is a savings more crisis, right? The more people can save today, the more compounding will play off in the future to higher account balances. So saving is by far more important than what your investment mix is going to be. And the problem with target date funds is they're simply based upon age. Your 401k plan sponsor defaults you into a target date fund based on age. Everybody at the same age gets the same portfolio, but even on this panel, we're not all the same people. We shouldn't necessarily be in the same target date fund.
Your point is saving anything at this point is more important than trying to figure out whether you've got a 60-40 mix, or the mix isn't as important.
Yeah, savings number one, investments are number two.
I would add to professional. It's important to know because Will won't plug his own company, but I know his firm well. Having a robo target fund and not touching it does not offer you downside protection. And Will's firm specializes in managing downside protection and protecting your assets.
Certainly active management is a good thing. However, you have to say if you're 26 years old, you're not going to be worried about whether the market's down this year. Anybody would be a fool to tell a 26-year-old to time the market.
You know what's amazing, to your point, just to extend that just a bit, when you're 26, when I first started in the business in the early 90s, they used to say use your age and that should be how much money you have in cash.
That would be insane.
And now it would be insane. You get forced into
it would be insane to have that in bonds.
Every year you would not have it, and you'd be one of those statistics having not enough in your 401k.
Oh, yes, thank God we got rid of that. And we're all living a lot longer than the old age groups would indicate.